Well, thank you so much, David. Price Headley here. Good afternoon, everybody. Hope you're doing well. Summer is almost officially started, though it feels like it started with the Memorial Day holiday behind us. And typically, summer means that the markets are going to chop, that we're going to see some backing and filling. Let's start with the markets. We'll go back to Tesla and others. Of course, the markets have had a great recovery, right? So I'll walk you through on the big trends methodology that I've got, how I look at the overall markets and individual stocks and anything else you want to look at, ETF sectors, you name it. But the philosophy is, of course, getting the major trend right is so important to your trading, right? You've got to have the bigger picture view on your side, and then you can adjust to come up with like shorter term swing trades or quick trades in that kind of longer term context, right? So what we've got on this chart, of course, we've got some averages and bands up here. So you've got a classic 200 bar moving average in yellow here. So that you can see right now the 200-day average on the SPY currently sitting right under 580, 579 and a half. We're above that. We had a test of it after we came back above it. So that test was validated that, okay, we're back above the long-term trend line. Compare it to, of course, when did the market start to have trouble? As we broke the 200-day, the yellow line, just starting there, we had to test back up into it. One close slightly above it. I usually like to see at least two closes in either direction in a row, above or below, to validate that the change in trend is happening on that longer term trend line. Then things, didn't get through that. So then it got the big downside on the Trump Liberation Day tariff announcement, right? We don't try to catch that exact bottom, right? We're not in the game of like catching falling knives at big trends. Our philosophy is much more about it's a lot easier to trade the middle of a trend, the sweet spot of a trend, than it is to try to pick tops and bottoms, right? And you'll get stung too many times. I remember watching John Bollinger at a MTA Market Technicians Association conference where he said his mentor told him he was allowed to pick the exact high and the exact low once in his trading career. He didn't really like those odds, and that kind of stuck with me. That the idea is that we're trying to define where the sweet spot is, where wind is at our back, and then align our trading with that bigger trend. Thus, the name BigTrends.com. I launched the company back in November '99 when everybody was talking about day trading as the path to wealth. I don't agree, right? I'm looking at bigger moves over many days, many weeks, many months. And again, you can adjust your strategy. We're mainly swing traders here, but we want to have that bigger picture view. So point being that we've rallied back up on the spot. You can see we just recently touched up to about 605. Those old highs back there, the February high, 613, but basically around 610, 611 have been tough coming into the December high and then again the January high. So with the 610 level kind of sits overhead. What are these other lines here? So the white lines are what I call my big trends bands. And this is a way to visualize the percent R when it breaks out above the 80th percentile. That upper white line is basically the 80th percentile reading for the percent R, Larry Williams percent range calculation. I use it at percent R as more of a trend following measure. I want to see it staying in that top 20% of readings. That's when we're above that white channel. That's an uptrend phase. Guess what? Below it, you can see it started to break down back here into the bottom 20% below the lower white line. Even before we broke the 200-day back, started on the 27th, but really followed through there by about the beginning of March. And that's where that first wave down hit. And then the next wave down there from late March into early April. That's where you can get free falls. That's where you can get crashes. That's where you can get a lot of speed of movement on a put trade, catching that breakage of that lower bottom 20% of readings. You can see the bottom 20% of readings on the percent R calculation. What are the other lines down here? And oh, by the way, we've got an 80 bar Bollinger Band in the purple upper and lower boundaries. That's a pretty useful tool as well, two deviations. I don't like the 20 bar bands. They're too volatile. I'm looking for the bigger moves outside of that upper unusual 80 bar line. Now, plot around an 80 bar moving average in the blue line. So that's all our lines on the top chart. We also got the CCI Commodity Channel Index in yellow with a moving average on that. And we want to see that go above that plus 100 or below that minus 100 threshold to tell me we're in the stronger trend phases. And then the bottom lines are your ADX plotted with your DMI. So the DMI plus is a blue line there, DMI minus is red, and then our green ADX line trending. We want to see in a trending market like the bear trend we had back here. Guess what? ADX started to break down and ADX actually started to rise. The market started to break down as ADX started to rise. That said, we had a downtrending potential as that ADX rises. The first leg of ADX through the middle of March caught that first wave, and then ADX trended again with the bearish line above the bullish line. That means we're getting a lot more new lows. And so if you ever have a problem defining what kind of a market are we in, is it net bullish? Is it net bearish? Who's winning the battle? between the bulls and the bears, I first start and look at the DMIs. Even with that look at the 200 days, I'm also looking at the DMIs and saying that positive DMI cross. We had two of those attempted crosses. And what I want to see is that cross is not good enough. I want to see a close above that high. So 568, 570, we weren't closing through there yet. So once we close over 570, it actually happened on the gap back up on May 12th that we closed above it, and that's where the directional movement lines went positive. Now, that doesn't mean you have to buy there in your whole position, but I will start to build bullish positions. But what I love are what I call retests. Now, a retest could be a big trends band retest. We had a band retest and a 200-day retest on May 23rd. We're getting close to those DMI lines converging into each other. I call them DMI kisses because when they actually look like they're crossing, like say at this point back here in November, right after the election, we had that big surge after Trump got elected. Then the markets came back down kind of hard and quick there on that November 15th pullback. That potential cross of the red line there above the blue, that's just what I call a retest. I will often buy those pullbacks in an uptrend. That is a buy the dip opportunity. And then I'll put a stop if it closes. I don't use an intraday stop. I use a close below that low. So if it closes under 583.86, I'm done. Right. So the idea is that you can buy those dips with some confidence. And so that's what we're really looking for here is what kind of names do you get into? And you can look at the Qs the same way, the Nasdaq 100, QQQ. It's stronger than the S&P, right? Its percent R started to break out even just underneath that 200 with more conviction added to it as we got that breakout on May 12th. You can see even when it pulled back, it didn't get back to the 200-day. We got close to our big trends band intraday retest at least. And we just had another one of those retests there on the fears on Friday about the Iran Israel bombing each other back and forth. Those pullbacks were basically buy the dip opportunities from the big trends band. We still have the problem of the 540 level double top from you can see mid-December, mid-February, that 540 double high there, double top, people might call it, is sitting out there as a possible problem. But if and when we get through that, that will open the doors to a lot more buying interest, in my opinion. So we're watching that, but not kind of going full guns a-blazing here yet, but still leaning bullish, right? And so then you look at things like gold. You got to look at gold in this market. Gold has been a champ. You see it's pulled back the last couple of days, but we're kind of right into a nice little retest area here. And here's my rules on a retest. We had a close underneath that upper white line. That's okay. I used the low of that bar, which was that's what I call a valid retest as long as it holds that low. Yesterday's low was 311.65. So we're actually below it right now. We tested the 310 intraday, but what I want to see is at the end of the day, we hold 311.65. If we don't, I close it out at the end of today, right? So if you're buying in today or this morning, anywhere in that 310, 311 zone, I'm okay buying it here at 311 and a half. And of course, you can construct all kinds of option strategies. I think we're just talking charts today, so I won't go deep on the option side. But I tend to like to buy an in the money option, sell an out of the money option. If I was going to sell an out of the money option against an in the money purchase, I would set it up off these highs here, 317, 315, the high there, 317 and a half. Right. So 315 to 317 strikes are strikes I would sell where I'd be trying to buy something like a 305 or maybe even a little more in the money if I had to get more of a stock substitute on my buy leg, sell some premium against it to get to a net no time risk type of a situation. And we teach a lot of options at Big Trends to walk folks through that. But gold, even though it looks like nothing here since that short-term high back in mid-April, right? Two months of going nowhere. But remember, it's gone a long way. And you see, what is this buy signal here? This buy signal is when we get a close over the 80 bar upper Bollinger Band. And I'm a big believer that what I want to look for, I do a lot of system testing and looking back over time and saying, how do we do on that system? And I look at something called the profit factor. You see, if you'd taken every long trade on gold over the past 10 years, you'd have a profit factor of 2.93. Anything over 1.5 is really good. So almost three on profit factor is even better, right? Now you see it's only had 12 signals, so it's not that active on this particular system. But yet, and you say, well, it's only 50% profitable. Here's the key. The size of your winner to the size of your loser is what's driving that success, right? You're almost winning 3 times as much as you lose. And you say, well, that doesn't sound that impressive. And that's where I had Tesla up early. I want to show you that for a second. Because obviously right now Tesla is not on an active signal, right? But I'm going to show you that chart in just a minute. But you can see when it was breaking out right before the election, it triggered break out through that band here. That was happening on October 25th. I bought some of the leverage vehicle TSLL, which is 2-to-1 leverage on Tesla, did pretty well with it even post-election here, where you can see that this one was breaking out, had a little pause. Notice our DMI lines, they're still net positive. A little pause in the CCI and the percent R lines is still staying above their midpoints. But the key was that look at the breakout after the election. It just ripped and ripped and ripped. And so from the buy signal at 269, the stock made a high 210 points, 215 points higher, right? And of course, then it's come down, and everybody knows everybody's all negative about Elon Musk, even though he's, in my opinion, our generation's Thomas Edison or Nikola Tesla, however you want to look at it. But I would classify him more as an Edison because, of course, Edison brought toward the world the first big name stock in GE, right? I mean, but basically the principle here is that this system doesn't exit until the end of the 80 bar moving average gets violated. But you can see the best part of the trend is when you have percent R trending, CCI trending outside of our bands here. Our big trends bands holding up on every retest, which they started to violate back in here. So I'll get out way ahead of this exit. That's just kind of a longer term test and kind of a guide. But here's the point. Why am I so interested in this system breaking those longer term Bollinger Bands? Because when you go and look at the profit factor on Tesla going back 10 years, which again, I think it's been around that long, but basically you see the idea that look at our profit factor. It's almost 33 to 1. That's insane. That is absurd. And of course, you look at the performance graph and you see it's basically straight up vertical. Of course, even more dramatic because of the big, huge move it caught post-election. But the point is that not only does it have a 71% win rate, and it's only had seven signals, right? You say, well, why are we talking about something that's only got seven signals in 10 years? Because if you trade those big trends and you even catch one of them a year, you can make a lot of dough. You can make your year off of one or two really good trends, folks. I mean, that actually came home to me when I was at a institutional investors conference years ago where a guy named John Henry, who ended up buying the Boston Red Sox, was talking about in his hedge fund world, if he had three big trends a year, big trades a year, he had a killer year. If he had two big trends a year, big trades a year, he had a good year. If he only had one big trade a year, he considered it a mediocre year, right? But that was an eye opener. Say these guys are not hyperactive trading intraday, scalping for thousands of transactions a day or a week or a month. They're looking at how they find big moves and how they keep building exposure into, for them, it's a lot of times currency trades or those type of vehicles, right? So anyway, I don't want to get too sidetracked, but the point is that my philosophy is very different. I'd rather you trade less often, but with much higher conviction, much higher quality. Because look at that. When you're right, your ratio of average win to loss displays how much you win compared to how much you lose on average. That, of course, you only had two losers and five winners, but it's saying that when you were right, you made 13 times as much as when you were wrong. You may have heard of a philosophy called R multiple trading, right? It's like you define your units of reward relative to each unit of risk you're taking. If you're willing to lose $100 and you can make $1,000 on average, that's a 10R multiple. This is kind of the same thinking, like a 13R type of a multiple where you can make a lot, lose a little. That's what we want to do in trading, right? So right now it's not there, right? Right now Tesla would have to break through this 365 upper band here on a closing basis to really get rolling again. And why should we deploy a bunch of capital until we know that's happening? But we can set up scans where we can pick up the freshest names that are breaking through there. In a moment, I'm going to go ask for your names you want to look at here. In fact, I'll go ahead and get started with it. Fred popped in one on AGS, but I'll pull up some of the other big names. So AGS is actually on one of those signals. Now, here's the problem for AGS is that its history is not good, right? It hasn't had a lot of signals, right? We're talking about looking back over the last 10 years or so. This is about 7 years of data because it must have started January of 2018. But you can see that it's lost money overall, and it's only been right 1 out of 9 times. Okay, am I going to buy that and bet on those odds? No. I'm going to say, okay, interesting, but I'm going to pass. But it's interesting that it's a low volume name. My view is I need high liquidity names that are optionable that I can put a lot of subscribers into easily, and more importantly, get out of quickly for a lot of subscribers without a lot of slippage, a lot of market impact, right? That it's us against a lot of other traders. So I wouldn't mess with it, but yes, I think you're reading it correctly there, Fred. It's broken out. And what you could do, of course, is you could just say, I'm going to define my stop based on the recent retest levels, right? You had a bunch of retests on it in the 12 and a third range. And you could say, okay, it looks like the move through about 12 and a quarter was meaningful, 12.32. So basically, you don't want to get much under 12 and a quarter. That little intraday low there, 12.26. I could say, fine, stop it out under 12.26 on an end of day close. I would be willing to do something like that, even if it's a retracement. You're betting it's not going to retrace that much. Generally speaking, I'll get noise out of some trades that I end up coming back. But the idea is that your first goal as a trader and investor should be to have relatively limited risk. But I like to use end of day stops or end of bar stops on an hourly, like the end of each hour. If I'm looking at a 60-minute chart, if I was looking at a monthly chart, I'd look at once a month. I have a service called Stock Doublers that just looks at once a month. Very simple, very easy. You find some of the most massive trends that you ever would have found in your life when you go back and look at our monthly charts, right? If you look at NVIDIA, we'll do that for a second. NVIDIA on our stock doubler system gave a buy in 2016. That's based on a super long-term trend line here. Those couple of retests held. And even through all the damage that everybody's feeling on NVIDIA here over the past few months, our system said, don't worry, it's still not even a retest, even on that pullback low of 86 and change. I've been telling our subscribers, look, keep holding it. It's okay. Look, it snapped back up from 86, now back at near the old highs, 145 and pressing. Like we haven't had a monthly close over 138. So right now, if it closes here at the end of the month, it'll be a new monthly closing high. If it closed above last month's high, 143 and a half, all those things would just validate that it's probably got even further to go, ultimately. But this is super long term, right? So the key is how do you have that staying power? Well, that's a long-term system, again, tied to super high profit factor, super high R multiple, the dollar and 17 cents in, now more than 100 bagger on that particular trade, right? Insane, right? But that's what you're after as that's more of an investor system, active investor, but still will rotate out of stuff that's not working. But the stuff that is working, you want to stay with it, right? Pop in some other symbols. But in the meantime, I'm going to pop up some of the other big names out there because you think about everybody's talking about names like Meta lately, right? And let's go back. We're just focusing on the daily chart, but you can do the same analysis I'm teaching you here with the breakout in Meta back at the start of June, breakout outside of our bands right in here. You see it caught that nice several day move for a nice swing trade from a first close over that band was 654.6, and it ran over the next week to about 700, right? So almost a 45-point move in Meta in about 5 or 6 trading days. That's very meaningful. That's something we're interested in from more of a swing trading perspective. The daily chart is a little more mixed right now, right? You can see it was a lot better back here. And again, this is one that's been in it for a while, so you got to go back to its last trigger point here. This is why I use the 80 bar moving average for a longer term kind of a system, is that it'll keep you in these little retracements where you're down at first off the August buy last year. Remember, had that August shakedown market at the start of August. It rallied, gave that buy. Remember, and here's another example where that prior buy was a loss. You bought it around 540, you stopped out around 490. You lost 50 points on Meta. That's about just what, 9% you lost on Meta on that move. Meanwhile, you're sitting on this one from 537 to the eventual exit at 627, right? So in that case, you make 90 points. So lose 45, make 90. That's a 2-to-1 reward for your risk. Just think of your systems in those kind of terms. Like, are you making hopefully twice what you're risking or more? That's really the ideal that we're after, right? The objective is to make sure that you put yourself in that position to have staying power in whatever you're doing. Let me ask you, are you more of a swing trader? Are you more of a day trader? Let me get some feedback from you real quick. Pop it in the chat box, because what I can do is I can change my time frame and teach you these same principles. Even if you're a day trader, you could use a short-term chart and do the same thing. Even if you're a swing trader, use an hourly chart or even a 30-minute chart, depending on if you want to be a quicker swing trader. The idea being that I can customize this for pretty much any kind of a time frame here. So, but in principle, the idea is, okay, so like let's say, okay, fine, you want to go look at a swing trading time frame. Okay, and Dan's a day trader. Okay, he was first in. So I could easily change this and say, you know what? I don't really love a 5 minute. I kind of prefer a 15-minute chart, to a 5 minute, because a 5 minutes got some noise in it. But you'll see that, on a name like Meta, triggered here back at the start of yesterday morning as a buy there at 705. And you can see it's kind of sitting there right now. It hasn't really gotten going compared to that last signal. But the idea is that, you can go through and you can look at these and you can say, okay, do I make money? And the problem I have with it is when I go look at the history on it, and this is looking back over 10 years of 15-minute charts, is you've made money, but not enough. You've made a profit factor of 1.03. That's okay, but it's not great. Okay. It's basically saying, I think you can do better, right? So what I'll do is I'll customize this and say, okay, well, that one didn't work. What happens if you look at a 30-minute? For whatever stock you want to look at. We'll look at a couple other stocks you might prefer. That's better on a 30-minute, right? Starting to improve on the profits and profit factor starting to move up. Does it get better on a 60-minute, right? So the key is that you can adjust your views to which one gives you a little more bang for your buck. You can see that we talked about that Meta breakout at the start of June. And you could do the same thing on Apple, Nvidia. Of course, one of the hot stocks that everybody's talking about, we're talking about it too, is Palantir. If I could type it in here, PLTR. And so, again, same principles here. We can say, okay, well, now on an hourly on Palantir, here we go. This is kind of interesting. Let me actually show you something here. So the profit factor is if it's at least above 1.4, we're getting interested. Above 1.5, even more. It's 1.63 on Palantir back to when it IPO'd back in 2020. Okay. And you can look at the performance graph and you can see that really most of that profits come here in the past year, right? From that low point a year ago to now, it was kind of not doing much. It was chopping around and then it's ripped here over the past year. We know that. We all can look at the chart and see that. But here's the key. You can see that right now you're on a buy signal. This is kind of an interesting setup right here on Palantir. Why? Because you're coming in after the breakout happened here at the close of 137.04. This is an hourly chart. This is a swing trader's view here. And saying, okay, the options are not cheap, right? But you can see there was a lot of resistance before in this 135 level. Then it got through that, kind of held it. Then we made kind of a little double top-ish potential setup at 139. Well, look at where we pulled back at this morning, 138.78. Look where we are right now, 139.15. So again, when I look at option setups, I'm saying, okay, I need to come up with some strategies that will manage my risk. And one of my favorite option strategies, again, I don't want to go too deep on the options because most of this is just a chart look, but one of my favorite option strategies for kind of getting that stock substitute approach and actually kind of getting some payment while you wait, if you have to wait, is to set up for a debit spread. So a debit spread means you buy one option, you sell another cheaper option against it to kind of lower your net outlay or your net debit. So if I'm looking, again, this would be really aggressive looking at this Friday's expiration. For most of you, I'd probably say go on out further, give yourself more wiggle room, more time. So you can kind of adjust this to whatever you think. Even if we went to next Friday and you're only going to hold it to the end of the week or something, at least go out to next Friday, right? But again, you could go out to the July monthlies, whatever you want. But notice the stock's trading 139. And these options are not going to be cheap, right? I usually look for what's called a high delta, which means we're getting a, a lot of bang for our buck on a higher delta. If the stock moves up a point, we should go up on that one like 74 cents on the dollar. We can see like a 132 call if we were looking at that one. Let's just look for just round numbers. For example, at the almost 80 delta, the 130 call. It costs you 11 bucks for a 78 delta, a 130 strike call. Well, it's worth 139 right now, 139.07, 139.10. So it's worth $9.10 and it's costing you about 11, which means that almost $2 of time is in that thing. How do you offset that risk? Well, you could say, well, you look, the recent highs were 144. I could go sell the 144 call and get back like 290. I could get back my $2 a time plus almost another buck of extra time for giving myself that upside to the old highs near 144. If you're really conservative, you want more cushion, you could sell the slightly out of the money 140s for like 4.5, right? So when you look at that trade for a second here, you say, well, if I was going to set that trade up as a buy, this is on TradeStation, buy a vertical debit spread and say that I'm going to buy the 130s and sell the 140s, just for the sake of just a round numbers of saying, well, that can be worth 10 bucks, right? Let's just do that real quick. If I can get it there, there it is, 140. Buy 130, sell 140. For each one of those you do, you would pay on the middle right now about 635. You might go in there and pay 640 or even 650. But the idea is that if you pay, say, 640, well, you look at that and you say, well, if I was going to place even one of those contracts, just to be really easy on the math here for a second, if I was going to do one of those contracts, you would invest 640. If it goes to 140 or higher, which is only a point above current levels, then you make $360 on your 640, just over a 50% return by next Friday if it stays above 140 at next Friday. And you go in with a stop plan. You go in maybe even with targets to say, I might take it out early if it gets back at the old highs, say at 143 or higher. Again, these are not advice. These are just ideas. I'm just showing you examples of how we set trades up. And then, of course, you scale it to what your size is. You never get too high or too low on any one idea. But the idea is that I would go in there and say, okay, define your risk and say, okay, if we're getting close to like this DMI kiss, and see the last couple of DMI test points here have been kind of valuable here, either on the bull or the bear side. And so those are often inflection points, like that when they're on 6.4, even though it only bounced back for a day and a half, that's enough bounce back to say, yeah, we can cash it in. Right now, I'd probably even be more conservative and say, let's put a target at 142 and a half. That's 3.5 points above current levels. I wouldn't let it have an hourly close under the first hour low, which is 138.78. We're only 30 cents, 25 cents away from that. And so, okay, that's why we wait for the end of the hour, which in this case would be at 1:30, 2:30, 3:30, and 4. Right. So that's how I watch an hourly. It takes more work on an hourly for more of a swing trading approach than a position trader on a daily chart. But you get the idea that these are how we come up with setups that are, in our view, relatively lower risk, risk managed, and of course give you more upside where you can say, okay, look, I might lose a half point. What if I even lost a full point if it slipped through there by the end of an hour? If I lose a full point, but I make 3.5 points on the way up, that's still a 3.5 R, 3.5 reward for my risk. You want to think in those terms. You want to think in terms of how can I reduce risk? How can I not be a chaser like a lot of other people are, get too extended, especially when you're using leverage like options. You really want to pick your spots. You really want to be really sensible about, okay, where's my re-entry? Where's my low risk spot that I can say, okay, if I'm wrong, I can admit it quickly, take moderate pain and move on, say enough. You never want to get married to a stock, right? Marry your significant other, but not your stock or not your option trade, right? You want to be maximum flexibility, maximum willing to say it didn't do what it was supposed to do, it didn't hold, let's cut and run. And so we've got a risk defined on a close under the first hour low. We've got, remember, that's a close. That's at 1:30 is the next action point. If it goes below there right now, I'm not going to panic. I'm not going to overreact. That's just talking you through how we do option trading at Big Trends. We have set up for you a special report where you can actually get one of my favorite strategies, our QQQ Options Playbook. And I think David has that link where he'll post it for you on that because I guess my time is down to the last couple of minutes. If you got a last symbol for me, pop it real quick and we'll look at it. Remember, we had popped that daily down to the hourly. But again, I love starting. Look at the Palantir on the daily, right? Look at how huge that trade was last year. You go all the way back to where was our band breakout? It was of July 5th, the day after Independence Day. There was your true liberation trade, right? 23.23 entry. It ran all the way to 125 for a five bagger. But of course, by the time it exited, it was giving back a chunk of those profits, right? Not an ideal exit. This is where you can use your short-term timing tools to maybe either take some risk off. Maybe you take profits on one options leg or one stock and replace it with another option, kind of roll it up, as we call it. There's a lot of ways you can then reduce your risk, but still keep participating. But you can see, hey, okay, fine. You only tripled Palantir on that move if you followed it to the March 10th stop. But look at the reentry here. The reentry was on the breakout at 124. You say, oh no, in 2 days it's down right after earnings. Remember, we got that negative reaction to earnings at first, down to 105. You don't overreact to that. You say, okay, the system says stay with the trade. I've got my stop down here. That's just part of trading. And then you see it's been grinding up ever since. But look at the retest. Look at how many retests you could have bought the dip, bought the dip, bought the dip as recently as that retest that kicked in on June 5th, low of 119, closed at 120, and bam, you're already back near 140, 20 points higher.